The combination of the biggest inflation since 1981, supply chain issues caused by the pandemic, rapid interest rate hikes, and a negative GDP have created a prime environment for a recession. How severe will the recession be and for how long is still unknown. So what can you do as an individual to prepare for this coming recession and avoid taking a major financial setback? First, let's understand what a recession is. Many say that recessions are defined by 2 consecutive quarters of decline in real gross domestic product, or GDP. But an article provided by the White House said that economists don't just look at one factor to determine whether the economy is in recession, but instead many other factors like the labor market, consumer and business spending, industrial production, and people's incomes. Whether we are currently in a recession or not doesn't negate the fact that we must prepare to survive and thrive during an economic downturn. So let's go over the 7-step recession survival guide. And by the way, all the resources used for this video will be linked in the description below. Step number 1. Do not be afraid of a bear market. Recently, the S&P 500 fell to a bear market, which means that the market lost 20% from their recent high. Now, this creates a little anxiety for everybody, especially investors, since they are the ones who feel the hit in their portfolios. Many of them panic and begin selling off their assets in order to stop losing money. The problem is that in many cases, when panic sets in, it might already be too late, and their assets have already lost value. By selling, one is simply locking in their losses with no chance of recovery. There are 2 ways to look at a bear market. One is to panic because you're losing money. The second is to look at it as a big sale of financial assets. In a bear market, these assets tend to go down in price, which means they are on sale, just like any item at a store. This allows you to buy these financial assets at a discount that have a good potential to grow. If we look at history, after every bear market, there's a bull market. So positioning ourselves correctly when prices are down can potentially be quite beneficial. As Tony Robbins always says, the market has never taken a dime from anyone. Only you did that. He refers to the people who get fearful and sell their investments during a recession and lose money, when they could have just weathered the storm and eventually recovered their losses. If we think about it logically, why would we sell something for less than what we bought it for? There are only 2 reasons: necessity and fear. Once we control our fear of a recession, we will be better equipped to prepare to take advantage of it. Step number 2. Don't try to time the market. A lot of people might want to get out of the stock market or reduce their stake until things begin to look better for the economy. There are a few problems with this method. Once we begin feeling the panic to sell, we might have already lost money and the markets are already down. And 2, no one can accurately predict the market. Even some of the smartest investors in the world get it wrong more often than not. No one can know when the right time to sell and buy back is, making this a very dangerous practice. The most effective practice according to some of the smartest investors in the world, like Warren Buffett, Ray Dalio, and many others, is actually the simplest. Stay in the market and dollar cost average your investments. This means invest a fixed amount of money at regular intervals. This will allow you to take advantage of the bear market without having to time it, which helps you eliminate the risk of putting all of your money at the wrong time. Step number 3. Get rid of credit card debt. Over the last few months, you might have heard of how the Fed continues to raise interest rates in an attempt to control the fast-rising inflation. Something that many credit card holders don't realize is that the APR on their credit cards might also be increasing without their knowledge. This means that the balance on a credit card is getting more expensive. So in order to reduce this cost, it is important to begin getting rid of high-interest credit card debts before it gets even more expensive. And if you're looking for ways to reduce your credit card debt, check out this video on the book Total Money Makeover in the right-hand corner or at the end of this video. Step number 4. Build an emergency fund, if you don't already have one. As we enter a bear market, cash becomes very important for 2 main reasons. Things might be going great for you, but recessions can change one's circumstances very quickly. And don't have a safety net, you might be put in a very tough position financially that might force you to begin getting rid of your assets in order to make ends meet. And the worst time to sell off an asset is during a bear market, because assets are already undervalued. Having to sell undervalued assets not only loses you money, but can potentially set you back years in your journey to financial freedom. So having cash reserves can help you avoid taking a major financial step back by allowing you to survive a crisis without selling your assets. Step number 5. Build your battle fund. Once you build your emergency fund, then it's time to create your plan of attack. As markets go down, financial assets get more affordable and the opportunity to build wealth becomes greater. For example, in the market crash of 2020, the S&P 500 fell over 32%. This gave many people who were prepared with cash a great opportunity to grow their wealth. The S&P 500 grew over 107% from March of 2020 to December of 2021, more than doubling in value in just 2 years. Those who were ready with cash took advantage of those opportunities and used a recession as a springboard to their financial goals. Step number 6. Do not underestimate bonds. Bonds are essentially debt issued by the investor to either a business or a government. When you buy a bond, you are essentially lending money to the bond issuer. And as the Fed increases interest rates, new issued bonds become more attractive to investors since they bring higher returns than previous issues. Typically, during a recession, bonds tend to outperform stocks since bonds are not as volatile. So while a stock is down in value, bonds might actually go up in value, helping stabilize investors' portfolios. And step number 7. Find ways to earn additional income. Recessions and market crashes actually have a deflationary effect on the US dollar, meaning the value of each dollar increases, since you can buy more financial assets with the same money that you could before. This is one of the reasons why those who have cash in hand during an economic downturn are the ones who can take advantage of the opportunities provided by a recession. So finding ways to earn additional income will put more money in your hands, which can allow you to take advantage of these opportunities and get closer to achieving your financial goals. In the comments below, let me know what steps are you taking to prepare for this coming recession. And make sure to check out this video on the book The Intelligent Investor by Benjamin Graham, which will show you how to evaluate and pick great investments. This is the book that Warren Buffett refers to as the best book about investing ever written.